What's going on, everyone? The local market data is in for November, and there are some interesting questions the charts bring up, plus the mounting number of issues that are making more and more people feel as though we are heading towards economic instability in the future. That's coming up right now. Welcome back, everyone. I'm Rick Harrison with MVP Realty in Southwest Florida, and in today's housing market update for December 6, 2021, I'm going to take you through November's newly released data and some interesting questions it raises, as well as its context in comparison to the stock market and global economic factors everyone is watching closely. Plus, today, I'm switching up the format a bit to quickly summarize the key pieces of information from this week's latest market news first, and then for those of you who'd like more detailed information, you can stick around or skip ahead to the stories you want to hear more about using the timestamps on the right to navigate. But first, if you haven't already done so, make sure to subscribe and click the bell to get notified of my latest videos each week showing you everything you need to know about living, buying, and selling in Southwest Florida. All right, let's dive in. On this week's agenda, we have the local market update. We have market news summary. So I'm going to just give you a quick summary of each of these following news stories from this week. And then I'm going to break down the news for those of you who are staying along to listen for the full details on each one. In this 7-day market update from last week, we went from 426 new listings up to 689 new listings this week. That's up 61%, which is always welcome news in a seller's market. For those buyers out there, the unfortunate news is that the solds went from 520 last week to 1063 this week. That's up 104%, which means we are on a half-life pace for inventory again, which means it's still staying in a seller's market, and the inventory is actually declining by half as far as this week's stats go. Extended's big recovery here, up 258%. From 46 last week to 165 this week, which means those contracts that were those homes that did not sell and their contract expired with their broker or their listing agent, they were being put back on the market. That's up 258%, which is good, but those were all already considered in the solds and new listings and pendings. And then we have the pendings up, so 775 last week to 956 this week. That is also showing that more homes just went off the market or are under contract and will be going off the market in the near future. So still showing signs of a very an extreme seller's market, and doesn't seem to be any relief this week. New listings since the crash. So this is from 2008. We see obviously in 2008 there was an influx of inventory on the market because of all the homeowners that had to sell due to the financial crash. So in 2011 and 12, we start to see that it kind of bottoms out, and then we see a slight increase in new listings up to 2018, and then a small decrease in listings down to 2021. Now, the interesting part that we see about this is that the consistency of the ups and downs between new listings, usually seasonal, is pretty consistent. And then at the same time, the increase and the decrease is pretty consistent too. If you were to draw a flat line or a trend line through the middle of that time period, you'd see that it pretty much stayed the same. It's just that we've been at a low inventory since the housing crisis that you'll see in a few other slides. But the big thing here is the bottom in 2013, and then we also have the shift in 2018. New listings have not changed that dramatically. So that's something to keep in mind. Obviously the trend lines have gone up a little bit and then they went down a little bit, but it evens out. So they haven't really changed that much since 2011 and 12, going into our current situation. The interesting thing here is homes for sale since the crash went from, in 2013, that's where the supply fell off extreme. So my question to any of you out there, there's been a lot of theories. I've read up a lot of different articles on what happened. But what happened in 2013, that's my big question to you. If you have any ideas, I'd love to hear your thoughts. Please leave those in the comments. I'm very curious why there's such a sharp drop-off in homes during 2013. They also had the average sale price since the crash. Obviously in 2009, we kind of bottomed out there with the average sale price, and then all the way through 2018, we see a pretty consistent trend line going up. But then when we hit the 2019 timeline, you see the dramatic increase in the average sale price. Obviously, the demand went up right around 2000, late 2019 to 2020 when COVID hit. Demand went up, and inventory was already low, so that forced the prices up. My question is why in 2000, late 2019, early 2020, did the demand increase so much? Obviously, some factors probably were that people were staying home. So they were looking at the fact that they were living in a place that, they were spending a lot of time in places where they weren't completely happy and wanted something else. So that probably drove some of the demand, but it's a fairly sharp increase. And we'll take a look at some other charts here. Closed sales since the crash. 2010, we see a level off in the market where it's pretty consistent all the way up through 2018 again. And then we see another dramatic increase in closed sales. So more people are buying and closing on homes as well. So not only did the price go up, but the closed sales, the amount of people buying, also went up. It's interesting that sales went up with such low inventory. So my question is, what's going on here? Is it the fact that the Gen X's and millennials are in their buying primes and they're starting to buy more houses? They're getting out of renting more. I'm kind of curious about that. Pending sales since the crash. So 2009, we see again a level trend line all the way through 2018, and then we see pending sales skyrocket as well. That's also consistent with the closed sales. And then the big thing here is this is the 3-year average days on market. So the number of days on market is just how long a house has to sit before it is usually an offer is accepted. Since COVID hit, we've seen the trend line on that. The average days on market go down. That's simply because there's just not enough inventory. So more people were being a little bit more lenient with the types of houses they were buying. We also had a huge influx of investors, especially in the third quarter of this year. Actually, almost 1 in 5 of the people who were buying homes in the third quarter this year were investors. So it's a pretty high number. But as you can see, we hit a bottom over the last 2 months as far as the days on market, and we've started to see an uptick in the days on market, which means more homes are staying on, which means buyers are less incentivized right now to buy, or at least that's their sentiment on where the housing market is right now. Interest rates for today, NerdWallet had it going from 2.978% for the 30-year fixed mortgage to 2.95%. That's a decrease of 2 percentage points. And then bank rate average went from 3.18% up to 3.22%, which is a change of 4 percentage points over the past week. So it's hovering right around 3% if you average those out, 3.1% or so if you average those out. Now, this is a couple graphs I wanted to show just to put in context where our housing market is in comparison to the stock market. We're just going to look at 3 different graphs that takes you from 1955, and we zoom in a little bit on each timeline. So as you can see, the trend line all the way up to the mortgage crisis, you see that little dip there, which was a big dip back then. But when you compare it to the entire market now, obviously was not that big. But as you can see with each of the dips, you have a nice steady curve line that it's a parabola of sorts. It goes up nice and steady on an incline, exponentially increasing. And then you see a drop off. And most of the drop offs were pretty dramatic, except for the dot-com bubble, which was it almost looks like the market cooled and then kind of dropped off and then recovered pretty quickly. And then you have, again, another trend line up to Black Monday, which was our housing market crisis of 2008. That dropped off significantly. And then you see the steep increase all the way up to about 2015. A little bit of a leveling off there. And then we go up to COVID, where there was a sharp drop, and then all the way back up. So if you take a look at the COVID drops, the spike, we have a pretty dramatic increase up to the market. And then as COVID hits, a really drastic drop. And then the recovery is much quicker than most of the other markets that we're looking at. So you see the trend line goes from incremental and exponential to more of spikes. So the only problem with a spike is you got to look at, is it going to be coming down anytime soon? And if so, how fast and how far? Now, if we zoom in, it gets a little bit less dramatic. 1978 to current, you see the 2000 and 2008 crisis and then COVID. It's not as bad, but you can still see that despite the ratios changing here and everything being even, the spike and recovery is very dramatic compared to most of the other recoveries that we've seen in the past. So that's the thing that's worrying me. And as we get closer in 1997 to current, you can see that the spike is still dramatic. It's not a exponential curve. It's a spike, and it's fluctuating quite a bit at the top right now. Now the top stories for this week are the Fed's hint at speeding up tapering in their December 14th to 15th meeting, and likely rate increases coming earlier in the year, as well as potentially multiple rate hikes in 2022. Next, over 300,000 homes are likely to come on the market or go to foreclosure in the next several months, with a lean more towards them going into foreclosure based on the current trends. Also, the FHA loan limit is increasing in 2022, going up 18% to 647,000, except in Monroe counties, which includes the Keys, it will be 710,000. And we also heard about Zillow a few weeks ago, and now Open Door stock has fallen 40%. Plus, Better.com, the tech mortgage company, is laying off 10% of its workforce, mainly loan originators. And at the end, I'll recap the growing list of the 13 biggest economic factors that will determine the future of the market. If you'd like more content like this, you can head over to my bio links in the description below and get access to loads of exclusive data, tools, and content like foreclosure, off-market property lists, buyer and seller guides, calculators, and the fastest and most complete property alerts on the web. All right, so now let's break down this week's stories and see how the macro could affect the micro. All right, for those of you who are still with me, the Fed's meeting, as I said, was on December 14th to the 15th, and Powell, he was hinting at increasing tapering speed. Some analysts think the taper will double to $30 billion a month, which put the original projection for July end to a new projection of February ending. Also, in other news, the IMF, International Monetary Fund Foundation, warns of collapse in low-income countries. So they're feeling the pressures of inflation all around the world. It's not just our market. It is in China, it is in Japan, it is in Europe, it's in Greece, it's in the Middle East. So it's felt everywhere right now, and the IMF is warning of the collapse in low-income countries, and for G20 countries to step up to the plate and help out. Now we're going to take a look at the story that came out on CNBC for the 300,000 foreclosures, and take a look at what they had to say about why this is happening and what the likely outcome is.
Well, John, nearly 8 million borrowers went into a COVID mortgage relief programs, but just over half are now current again, according to Black Knight. Still, there are about 264,000 homeowners who expired from their forbearance terms and are now delinquent, and 38,000 more already in active foreclosure. The strange twist here is that unlike during the subprime mortgage crash, these borrowers have substantial equity in their homes thanks to soaring home prices during the pandemic. Close to 3/4 of the borrowers in foreclosure have more than 20% equity, and just over 1/4 of them have more than 50% equity. That's according to Realty Track. And that's those in foreclosure, but the shares are likely similar for those 264,000 who are expired and now delinquent, but haven't yet reached foreclosure. So in total, what does that mean? It could be 300,000 likely lower-priced homes coming onto the market over the next 6 months. The question is whether the homeowners will decide to sell or wait out the foreclosure process. The current housing shortage is so bad, some estimate we may need more than 1 million homes just to meet the current demand. John?
Diana, that makes me wonder, might this process take longer than expected because so many of these homeowners do have equity? Might they have more options? And so might the market impact not hit as immediately?
Well, they have equity in their homes, but if they can't pay their mortgages, then they're going to have to do something. The banks aren't just going to let them sit there and not make payments. The issue is, though, do they sell immediately or do they wait for foreclosure? I would have thought people would have just sold and taken the profits and gone on. But what some in the market are telling me is that these folks have nowhere to go. That is, the rental market is so expensive and they obviously can't buy another house. So they are just sitting and waiting because at least they can wait this out and not have to make a monthly payment. So it could take longer, John.
And so then what's your take on the overall impact on the housing market?
Well, these homes will eventually go for sale. And the question is, do they get bought by owner occupants who want to live there, or do they get bought by investors and turned into rentals? What we know now is that this market is incredibly lean. We need more homes for sale. You're talking about more than 250,000. Yes, we need about 1 million, and the builders are ramping up. But 250,000 is not too shabby when you talk about getting more homes onto the market. Again, do they go to homeowners or to investors?
Yeah, especially.
We'll find out.
Yeah, given that inventories have been so thin. Diana, thank you.
All right, moving on. The FHA 2022 loan limits for most of the U.S. The 2022 limit for one-unit properties will be $647,200, an increase of $98,000 from $548 in 2021. So that's an 18% jump, and it's a huge that's a huge number to jump for allowance. The new 647 conforming loan cap applies to all of Florida counties except for that one that I had mentioned earlier, Monroe County, which includes the Florida Keys. The cap will be 710 there. Open Door and Better.com. So just an update on Zillow. Zillow does have a class action lawsuit against them right now from the iBuyer program. They were not the largest company doing that. Open Door was the largest iBuyer, and they were larger than Zillow by quite a bit. And then Better.com is a mortgage loan origination tech company. So Open Door stocks, they plummeted just over the last week. And two of the reasons that I had mentioned, fewer home sales or home prices declining across the U.S. Open Door is also their majority of their money is made from flipping houses and selling them. So their iBuyer program is really at the heart of their sales, whereas Zillow is more of a real estate tech company for agents that sells leads to real estate agents, and they have a CRM system and some other products and services that they offer. But Open Door is mostly for buying and selling homes and making the profit margin in between. Better.com lays off 10% of their mortgage loan originators. There is a video floating out there on the internet. You can look it off. Better.com CEO lays off employees, something like that. Type it in Google. It was a pretty harsh video, I'd say. You don't find out to the end what he's actually doing, but mortgages predicted slowdown in the originations over the next 18 months. That was one of the factors that I think probably is playing a role in the layoff. But the layoff also comes, as I said, at the same time or simultaneously with an influx of money from an investor. So it could also have to do with that the part of the deal was that they would need to cut back their employee workforce in order to have the investors come on and make room for the investor. Just to look at Adam. Adam is a data service for real estate agents, not just real estate agents, but they do a lot of real estate data collection. And the U.S. residential mortgage originations, as you can see, this is a pretty interesting graph to compare because the last time we saw highs like this that we're seeing right now in 2020 for refinancing, for purchases, and for HELOC, well, not for HELOCs, but for purchases was right in 2005, which was at the peak of the market before the financial crisis. So not saying that this has any correlation. It could, very well could, but I just think it's interesting that that comes along at the same time. And as you can see, we have kind of hit a peak in 2021, and now you can see the last 2-3 quarters, that peak has started to shift the other way. A lot of people are calling for a shift the other way, and as you can see in 2005, when that happened and we hit that peak, it reversed and went the other way, almost back down to what it was before the dot-com bubble. The growing list of instability factors, those of you who've been waiting on, the Omicron variant obviously right now is a huge issue that is still unclear. We're not sure what the reaction is going to be. I think the sentiment overall is that people are kind of done with shutdowns, at least in the United States. They are talking about it overseas, and they already have done it in some areas overseas, over in Europe. But we're still not really sure what the fallout is going to be from this in our economy. The historical high inflation right now, it's no secret. Even the feds are finally, they are retiring the word transitory. and they are admitting that inflation has got out of hand and they need to start making steps. So I think in the next 2 weeks we're going to know what the steps are going to be, if that taper is going to increase, and if we're going to be looking at interest rates rising sooner than we thought. Also, average 1 in 5 home purchases were investors of the last quarter. So that's a huge amount of people who are investing, and that also goes along with what we were seeing from Ivy Zellman's data that she had mentioned several weeks ago, that she doesn't think that there is an inventory issue. She thinks that the inventory is actually all being scooped up by investors, and that eventually, if this bubble of sorts or some economic factors happen where it does pop, that could be a slight decrease in the home prices over the next year or two. Crude prices, obviously, that's a huge thing right now. Commodities, it's volatile at both the top and the bottom. If crude prices grow too high, could worry just the economy and the people in the economy in general, to where they feel like the inflation pressures are out of control, which would mean them cutting back from spending, which puts our economy, our economic recovery into I guess, more into a bear market. And then you also have, if they get too low, then investors get worried and they sell, and that could crash the market too. So right now, crude prices need to kind of stay stable and somewhere in a, they can't go up to $120 or more a barrel, or even up to 80 a barrel. They can't drop down to 40 or 30. So Fed tapering in rates, we already talked about that, the 2 times rate taper, and the rate increase is coming earlier in the next couple months. The debt ceiling, December 15th, we have a debt ceiling crunch. We got to come up with that too, in addition to what we just finally funded the government for another couple months last week. Now we have next week coming up, the debt ceiling needs to be raised or compromised on that. And then the margin of debt right now, this is the highest, and a lot of this is coming from younger investors right now, especially like things like the meme stocks and those rising. A lot of investors, especially younger investors, are taking out margins on their money to try to make more money in a short period of time. The numbers, though, are showing that the amount of people who are leveraged right now at 70%, it's the highest it's been since the dot-com bubble in 2000. So that suggests a lot of speculation going on in the markets and the stock markets, which has and plays a part in the housing market and the economy overall. Also, there you go, the meme stocks, young traders are over leveraged right now. So that's just kind of falling in line with what we've been talking about as far as the market valuations. The valuations in general, the Schiller PE predicts a 20% drop just based on history, because whenever we've gotten over a certain percent in the PE, it's always dropped. And in this case, where we're at, usually after we've hit that mark, it's usually dropped 20%. So that's something to be on the keep an eye out for and be on the lookout for. Also, investor sentiment right now, investors in general think in patterns and they think in cycles. They always think about history repeating itself. So if that is the case, then the investor sentiment right now, which we're starting to see, I think, spill out into mainstream media, is that the market is worried right now of inflation and everything else that's going on. Also, overseas, Evergrande was something we've been talking about. However, another company, Sunshine 100, which is also, I think it's the second largest in China developer, as well as Kaisa and Fantasia, which have been talked about for the last couple of weeks. They are all in trouble. Sunshine 100 just defaulted on their 5th payment. So they're in trouble right now, and essentially they don't have enough equity in their company or enough assets to liquidate to actually cover their debts. So it looks like they are just a matter of time before they default again and they go bankrupt. And that's the same with for most of the real estate industry in China right now. That's why there's a huge housing crisis over there. Entire towns are half built and people are living in them, but nobody else is. It's a really weird situation. And Evergrande by itself, the Chinese developer, is 30% of the GDP over there. So if that does take a hit, that's going to affect a lot of the economy throughout the world. And then we also have obviously the relations and tensions between these countries, China and Taiwan, Russia and Ukraine, and then we also have an entire situation going on in the Middle East right now that's requiring humanitarian and political help. There's a lot of strife over there. So all of these things, all these factors could potentially lead to something. And I know it's a lot to think about, but there are a lot of moving parts in this era that we're in right now, and it feels kind of not transitory, but it feels like a transition right now. It feels like something is happening. I don't know what it is yet, and I don't know how they're planning to fix all of these things right now. But I think I do have hope. I think we will figure out a solution, and I don't think anybody should really worry too much right now. But just keep an eye on these things as we go. These are the sources. I used some articles from Bloomberg, Atom Data, Trading Economics, the Southwest Florida MLS, CNBC, NerdWallet, Bankrate, and the Motley Fool. I did not use any YouTube videos. That video came from CNBC. Well, that's this week's housing market update, and I know the list seems to get longer every week, but this is exactly why timing markets is so difficult. I'd love to hear your thoughts in the comments on what you think may have caused the supply fall off in 2013, or what your thoughts are on this new video format. I'm always trying to improve these videos to help my clients better and my audience navigate the Southwest Florida housing market. And if you enjoyed this video, please hit that thumbs up button to let me know, and don't forget to subscribe and click the bell for more videos every week. Thanks so much for watching, and I'll see you next week. Thanks for watching this week's episode. If you have questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swflrelocationteam.com. And don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and off-market property lists, buyer and seller guides, calculators, and direct access to the local MLS. Thank you for watching to the end, and I hope to see you next week.